Today, we're diving into the fascinating and often chaotic world of high probability trading. We're going to look at a popular strategy people use to try and get an edge, the scandals that can happen when things go wrong, and a really big question this all raises about our economy. And really, this quote just nails it, doesn't it? Everybody's looking for that holy grail, that one secret trick that promises instant profits. But does it even exist? That's the real question. So, here's our roadmap. First, we'll get into why people are so drawn to trading in the first place. Then, we'll break down a specific strategy called momentum trading. After that, we'll see what happens when these neat strategies hit the messy real world. And finally, we'll zoom way out to ask what it all means for the bigger picture. Okay, so first up, why this obsession with high-speed trading instead of just, patient long-term investing? Well, it really comes down to a very potent mix of simple math and the very human desire for quick results. I mean, this slide really says it all. The appeal is speed, right? Investing offers this slow, steady climb. Day trading, on the other hand, seems to offer a rocket ship. And that promise, making a year's return in a single day, that is incredibly powerful. But here's the catch, and it's a big one. The hard reality is that most people who try day trading actually lose money. So to try and beat those odds, traders hunt for systematic, data-driven approaches, so-called high-probability strategies. And that leads us right into one of the most popular high-probability strategies out there, momentum trading. The idea is actually pretty simple. Instead of trying to guess what the market will do, you just follow what it's already doing. So what does that actually mean? Well, think of it like basic physics. An object in motion tends to stay in motion. Momentum traders are betting on that same idea, that a stock that's rising will probably keep rising, at least for a little while, and one that's falling will keep falling. But it's not quite as simple as just looking at one chart and jumping in. Nope. According to strategists like Robert C. Miner, the real key, the secret sauce, is to see the same trend playing out across different timeframes. When you see that alignment, that's when your odds supposedly go up. All right, let's walk through it. Take a look at this chart. This is step one. A trader starts with the big picture, a long-term view like a daily chart. They're just trying to figure out the main direction. Is the market generally going up, or is it heading down? This tells them whether they should be looking to buy or to sell. Okay, so once they have that big picture trend, then they zoom in. They switch to a much shorter time frame like this 5-minute chart. And what they're looking for is a little flicker of movement that aligns with that bigger trend, like a small dip that starts to turn back up. That alignment is the signal, the trigger to get into the trade, with the theory being the odds are now stacked in their favor. It all sounds so logical on paper, right? Find a pattern, place your trade, follow the rules. It's all very neat and tidy. But what happens when these clean strategies crash into the messy, chaotic, and sometimes dirty reality of the markets? What if the game itself is rigged? And that's when we have to say, welcome to the casino. This is where those clean theories about trading meet the wild reality of human greed and hype, especially in a place like the crypto market, which can often feel like the Wild West. Yeah, that quote really cuts right to the bone, doesn't it? When you're in a zero-sum game where every single dollar someone wins is a dollar someone else has to lose, the incentive to bend or outright break the rules can be overwhelming. So, what are the warning signs? The red flags you should be looking for. Well, watch out for executives with shady pasts, a total lack of transparency, systems that are so complex you can't possibly understand them, and of course, that constant, relentless hype about easy, guaranteed money. And if you want a perfect and frankly tragic real-world example of this, just look at the collapse of the Canadian crypto exchange Quadriga CX. Its founder, Jerry Cotton, had this whole persona of a tech wonderkind. But behind the curtain, a massive fraud was playing out. After Cotton died under very mysterious circumstances, the truth came out. There was a $200 million hole in the company's books. Turns out, customer money had been used to fund his insane lifestyle and cover massive trading losses. No trading strategy in the world could have protected you from that. And it's not just about individual bad guys. Even systems built on supposedly unbreakable code can fail. The famous DAO hack, where a simple loophole was used to drain millions of dollars, proved that even in a world of pure code, things can go spectacularly wrong. It really makes you ask, what happens when the written rules of a system are used to violate the spirit of the system? All of this, the strategies, the hype, the fraud, it forces us to step back and ask a much more fundamental question. Is all this frantic, high-speed financial activity actually creating anything of value? Or is it just a really sophisticated way of moving existing money from one pocket to another? Now, this is not a new question. For centuries, economists have tried to draw a line between activities that genuinely create new wealth, like building a factory or inventing a new technology, and activities that just shift existing wealth around, like speculating on asset prices. The real challenge has always been figuring out exactly where that line is. Probably the easiest way to think about this is to imagine the economy as a giant pie. Value creation is all about making that pie bigger for everyone. Think innovation, production, new businesses. Value extraction, on the other hand, is about fighting to get a bigger slice of the pie that already exists, often without actually adding anything to it. And as the economist Mariana Mazzucato argues in this quote, our modern world has kind of blurred that line. We tend to think that if someone is making a ton of money, they must be creating value. But that confusion makes it really easy for activities that just extract wealth to disguise themselves as something productive. Which leaves us with this final critical question. In today's incredibly fast and complex markets, where exactly is that line? Is a high-frequency trader creating value by making markets more efficient? Or are they just extracting tiny bits of wealth, millions of times a second? How we answer that really says a lot about what we value as a society and what kind of economy we ultimately want to build.